Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, on a day that gold is up, again, almost $40, silver's up big as well, we welcome back our good friend and gold and silver expert, Steve St. Angelo of the SRS Rocco Report. It's great to have you back, Steve.
Yeah, Doc, Eric, a lot of things are happening this year, and looks like it's going to be a tremendously interesting year going forward, so we got a lot to talk about.
Well, let's get right to it with the markets with gold and silver. What's your take here as we get well underway in the first quarter here, Steve, and the action that we've been seeing in gold and silver particularly?
Yeah, last year, on a few interviews, we thought we would see the markets start to crash at the end of the year, and there's a lot of retail buying of silver, and so I thought, as well as many investors thought, we would see the market starting to crash and head lower, and then the precious metal prices increase. And in August, it started to do that, but then the central banks came in and propped up the system which most Americans are invested in. However, we're seeing a change this year, and started in January, and you saw some huge declines come off the broader markets, as well as the Asian and European markets. So during the real big down days, we saw some nice moves in the precious metals. And I think they would have been even higher if the price of oil wasn't so low, but that's kind of been pulling down on it because the cost of production is lower. But now, last week, we saw a 5% increase in gold, and the same thing with silver. And then today, the markets didn't really fall much. But boy, we had a nice pop in gold and silver. So I think there's a lot more buying now going on, especially in gold, and I think the supply-demand situation could really become interesting if we start to see really red days, real down days in the broader markets. I don't see a slow increase in buying or a slow increase in price. I think we're going to see days the prices are just going to go bonkers, and then this year we could see a total overwhelm of demand, of supply by demand. And if the conditions continue to get worse in the financial and economic system, especially with Deutsche Bank, I think 2016 could be the banner year for precious metals.
In the context of that, you recently wrote an article, Collapse of the Paper, Gold and Silver Market, maybe close at hand. And that's running on Sprott Money and also Zero Hedge right now. Can you speak to that in the context of the ETFs being halved, the COMEX's vaults with registered both in now gold and silver, showing signs that there's just extreme stress in the system, and the ability for paper manipulations is wearing thin?
Yeah, I look at everything as trends, Eric, and what happened is we had the price of gold held at 35, but then we had the London gold pool in the 1960s dumping a bunch of gold in the market to keep it there. Well, that didn't last. Worked for about 7-8 years. And then Nixon dropped the gold peg in 1971. So no longer was the dollar backed by gold. Well, then we start trading futures contracts on gold on the futures exchanges, I believe in 1975. So no longer was the dollar backed by gold, it was backed by the paper price that was set on a futures market. Well, this has been taking place now over the last 40 years. However, if you look at the trend of the owners per ounce for registered gold, if you look at a 10-year chart of it, it was basically flatlined. 5 owners per ounce, up until maybe 2012. And then it started rising, especially in 2013 when gold was crushed I think it went from 1,600 down to 1,150 in a very short period of time. Well, if you look in 2015, and especially now, this line of owners per ounce of registered gold on the COMEX has gone exponential. And I think it hit a peak of close to 500 a few weeks ago. But ever since then, I think there's been some transfers to J.P. Morgan and so now it's back in the 200 range. But that trend is still exponential. And if we look at the silver COMEX owners per ounce, and this is registered, I think April last year, there was 70 million ounces of silver registered inventory. Now there's 28 million. So in a year, we see the number of ounces of owners per ounce have gone from about 12. Now it's barely touching 30. Now this isn't the extreme as in gold, but it's all heading in one direction, leverage.
Yeah.
So now we're seeing this paper leverage now is basically propping up the gold market and the silver market. So I think going forward, we're going to continue to see more silver taken off, I think, the registered silver inventories. And with this new ABX fully allocated gold exchange, I think that's going to put a lot of stress. That's going to put a monkey wrench into this highly leveraged paper system. So with crashing markets this year, the Dow Jones, S&P, as well as other indices around the world, I think demand, we're going to see physical demand especially grow in this ABX allocated gold, and I think it'll put a lot more stress on this highly leveraged COMEX-based paper system. So this could be the year we could see, I'm not saying a default, but we could see prices get really silly. What do you think, Eric?
No, I agree with that. And we'll include the COMEX Warehouse registered gold stocks graphic that you have in your article in a write-up of the show here. So for folks that are just catching us on YouTube or whatever, do check out the write-up because we'll have it here. I mean, if a picture speaks 1,000 words, this speaks 10,000. I mean, and what also is interesting is that the shift, the inflection point with registered gold stocks, it began to move after the drive-by April 2013 manipulation shooting. And that there's a correlation here. A lot of people try to poo-poo the analysis of the registered gold stocks over time, but when you look at it through a 10-year lens and see what has happened in the last couple of years as well, they are in fact correlated with significant events where there is a shift in overall gold flows and demand. And it speaks to the stress in the system. And frankly, I find it kind of surprising that there's just kind of and people deny or poo-poo this information simply by saying, well, you can just flip the inventories between registered and eligible, and that's it, nothing to see or move along. And that's just disingenuous analysis.
Yeah, and let me add one more thing. I just wrote an article today. Maybe you were going to get to it, but I like to look at trends because, yes, is World Gold Council data, is it manipulated? Could it be off? Yeah, I think the Chinese, especially Chinese demand is off. But it's something to go by. And when we see demand or trends change significantly, even official data, that gives us a clue how much things are changing. And if we look at 2003 to 2009, the central banks were net sellers of gold.
Yeah.
And I think they dumped 91 million ounces of gold during those 7 years. Well, this turned around in 2010, and they've been net purchasers of gold, and that's mostly Eastern central banks. But this is what's interesting. If we take gold, physical gold bar and coin demand in 2003, and then we minus the central bank sales, because that's liquidation of gold investment from the central banks into the market, and some of that gold went into jewelry, it went into technology. And so what we had actually in 2003 was a negative 318 tons of net gold, physical gold investment. This actually is amazing how much it turned around. In just 10 years, 2003, it's a positive 2,300 tons. So we went from a negative 318 net physical gold investment. Now central banks are buying gold. And I think that year in 2013, it was 625 metric tons and a record 1,700 tons of bar and coin demand. pushed it up to like 2,300 tons. That year, it accounted for 52% of total demand, while prior to 2008, when the U.S. investment banking system went belly up, Lehman Brothers and Bear Stearns went bankrupt, we only saw a single digits, or let's say 10% of physical gold buying. So there's a lot more stress now, even in that market. And I think that's just going to continue to get worse.
Why don't we focus in a little bit here on what we're seeing in the physical market, both on the demand as well as the supply side, guys. On the demand side, demand numbers are they're on pace for all-time records. I mean, the U.S. Mint has sold almost 9 million Silver Eagles through a month and a half. We're here in mid-February, and looking at the calendar here and their weekly allocations, barring an unforeseen event, we're going to be over 10 million coins by the time February ends, is my prediction. I mean, demand continues to be really just mind-boggling. Last Thursday, when gold and silver both exploded, SD Bullion, we saw by far the greatest single-day sales day we've ever had in our, 4 or 5 year history. And again, we're talking about numbers that are at the end of a nasty 4 to 5 year bear market or consolidation period. That price action has been atrocious for those who believe in gold and silver, and sentiment is near 20-year lows. So, and yet the Canadian Mint, the U.S. Mint, they're all running on allocation. I mean, they've been in allocation since last June. I mean, we're 8 months that the Royal Canadian Mint and the U.S. Mint have been allocating Silver Eagles and Silver Maples, and frankly, I don't see that ending anytime soon.
Yeah, and what I think is interesting to add to that is I call the perfect storm in silver is coming, and that's where we start to see declines in supply while demand really picks up. And I think the key demand factor is going to be investment demand, and that has been the driver. Industrial demand has been falling a few percent every year. Jewelry is a little bit higher, but it's been about the same. Silverware is falling, and of course, photography has been falling, but overall industrial is falling, and I see industrial continuing to fall, so I don't care how much industrial demand there is. There'll still be a good bit of it, but that sector doesn't really, won't really do much in the whole scheme of things. So what I think what's going to happen, there's two things that are going to happen going forward in the next few years, starting this year. Even though we did see some big declines stated by like Australia, I think they were showing 41% decline in silver production in the second quarter. Well, this jumped back up in the third quarter. And Peru was actually, they had 8% growth because they brought on some base metal mines. But overall, I think production in 2015 is going to be a little bit lower. It won't be that much lower, maybe 2 or 3%. But this year will be a big factor. And it will depend upon how things unravel. And if we see a continuation of the unraveling of the U.S. and world markets, it's going to put a lot more stress on copper and the base metals. And that's where I see the majority of declines. Even though Endeavor Silver will shut down one of their mines and reduce production by 25% this year, I don't see that happening with many of the primary silver miners. Where I see production falling is going to be in the base metal industry. And I just think that's going to get worse going forward because of the huge debt in the system. And so as we see the price of oil stay low, even though we might see spikes, I don't see it rising. And maybe we can talk about that toward the end of the conversation, the interview, because there's some interesting things going on. Mm-hmm. It's going to cut dividends for oil companies. They're going to have to cut dividends because they're not going to be making profits to pay dividends, as well as the big Dow Jones companies.
Yeah, they've been doing it already.
Yeah, so when you see stock prices falling and then dividends falling, well, then it makes a good, the whole idea of not owning gold and silver because they don't make a yield, it doesn't make any sense anymore. You want to protect wealth, and I think that's where we're heading. I think 2016 is going to be a trend change for investors to, instead of making yield, is to protect what they have, their wealth. And all we need, and I've said this before, Doc and Eric, all we need is a 1 to 2% increase of global silver investment demand. And I think that will come from the wealthy and institutions. And that will totally overwhelm the market. And that's when we'll see the perfect storm. Falling base metal supply for silver and increase of in a wealthy and institutional investment demand. And that's when we will start to see the price get out of hand.
Yeah. And there's even a scenario where industrial demand in a dynamic fashion can start have like examples where suppliers will be constrained because the investment demand is just sucking up all of the market's available silver, and then industrial purchasers get nervous, kind of like what happened with Ford Motor Company back in the late 1990s when they were very nervous about not being able to source palladium, and the palladium market went berserk because they made huge purchases on the market. And there's a very clear scenario where, yeah, okay, we may lose 100 million ounces a year in industrial demand, so be it. But that's actually pretty small compared to the really large explosion that can happen in investment demand if you only have a small increase, 2%, whatever, of people participating. And it's going to be a lot more than that. I mean, the old saying about there's nothing like a gold or a bull market like a gold bull market. And the precious metals will move. If we have reasons for the masses to be very frightened, it can be truly explosive and one for the record books.
Oh, yeah, and thank you for bringing that up. That is so true. Industrial demand purchasers of institutions and or industry users purchasing silver, even though demand may fall 5 or 10% in a year, that could be totally offset by, as you said, a fear that supply will not be there.
Yeah.
And I think that this will happen too, because when industrial users as well as institutions realize silver's investment store of value, having silver, let's say you need 2 million ounces of silver for a given period for your usage. Now, why not have 5 million if silver is now a store of value? So even though you might not need to use that for that quarter or that half a year, it's now become an investment asset. So I think the whole trend change coming forward, you're right, industrial consumption could increase just because these institutions want to stockpile silver, not because they're using more of it.
Yeah, and you know, the electronics industry or solar or what have you, I mean, those purchases go in as a percentage of the final goods sold, very small. So it isn't even just an inventory question as to the purchase manager seeking to have a store of value on hand and benefit from that, but literally whether or not they're going to be able to make the product or not. And if it only costs $1 worth of precious metals for $1,000 or $500 end product, the fact that investors sending the demand for precious metals up and pushing silver prices up a lot really will not be material on a per unit basis for the industrial demand consideration. When you're sitting there and running your factory, you need the silver to produce the goods. You really don't have much choice. And I really do believe that that's actually what we're going to see. People look at industrial demand as something that's just going to be a lead weight, and I agree. That's going to be the first phase during the third phase of the bull market as it unfolds. But then at some point, I think even the industrial demand folk will get a little skittish as the ability to get silver becomes a lot more difficult.
We'll see. I want to backtrack just a little bit to what you guys were talking about as far as just and kind of highlight just the mind-boggling numbers when we talk about the percent of capital that's currently invested in the precious metals market and what a significant shift would mean to that market. When we're under 1%, what would it look like in 5%? And I want to draw the listeners' and readers' attention to something that's not usually talked about. Usually we focus on either physical, actual metals in your possession, or else the miners. But just as a note to kind of conceptualize and highlight that, there in the actual physical investment precious metals industry, there's only one company that's publicly traded, and that's A-Mark Precious Metals. And if you take a look at their market cap and what they trade at, right now after the huge Q3 of last year, A-Mark's market cap has doubled over the past few months. And A-Mark is the largest metals wholesaler in the world. They're just ginormous. And maybe you guys know, but if you don't know off the top of your head, I'd like to hear Eric and Steve make a guess at what their market cap is.
I'll let Steve go first.
I have no idea, to tell you the truth.
500 million?
Yeah, 500 or a billion. Is that crazy? Is that too high?
No, I mean, if I was making a guess off the top of my head, I would have said probably 2 to 3 billion based on the volumes I know they do and how big of a company they are. They trade on the NASDAQ. With their prices doubling over the last few months, they've skyrocketed to a market cap here today as of Thursday the 18th of $139 million. That's at their shares trading at 52-week highs right now. That's the largest physical precious metals wholesaler in the world. I mean, they're massive. This is A-Mark Precious Metals, and their market cap is $139 million.
Yeah, one thing that just goes to show how much the industry's hated.
And when you mentioned about how little physical investment there is, it's true. I think according to GFMS, and this is adding in what might be private bar and round, and so my number is about 240 million ounces of physical bar and coin in 2015. It could be more than that. Let's just say 250, just to make it even. That's less than 1% of world buying. I think it could be 0.5%. But if you double that, if you go from 1 to 2, you're talking 500 million ounces. And then if you double it, you go to 4%, let's say 3%, you're talking 750 million ounces, almost all of global mine supply.
And I'll tell you that the private mints, over time, the private mints will respond to that doubling demand. It's not going to happen overnight, but give them 6 to 8 months, and the private mints will respond to that doubling demand. The government mints will not.
Yeah, and the thing is, that could even be 1,000 ounce bars. Just pop it the refiners 1,000 ounce bars, and so I think that's the issue, and I think that's the reason the price of the metals. You see, the price of the metals are being traded as a commodity. What the cost is, this is gold and silver, and then what the supposed supply and demand is. Well, that's not their value, and I've said this before. Their value is their store of value compared to all the other competing assets, which are paper assets based upon net present value, and we need to have growing energy supplies to make that whole system work. And now that we're starting to see a lot of stress in the oil market, net present value in treasuries and stocks and bonds, I see them just going down. And so when that light bulb goes off in the market, that the value of paper assets aren't really there. It's kind of like Enron or Bear Stearns. One day it's 92, and the next day it's $2. This is the exact opposite that happens with gold and silver, and so their real value becomes understood by the market. And let me just say this one last thing. I wanted to add this in about supply. Something strange is happening with the U.S. market because we saw a huge increase of silver imports in December. I think it was up 33% from November, 557 metric tons in December. And that's one of the highest imports the whole year. And so we had 1,000 extra tons of silver imported in 2015. But industrial demand has been falling. Well, people say, well, we had a lot more investment demand, right? We had the official coin sales move up, and we had more private bar and coin sales. But the registered silver inventories plummeted from 70 down to like 30-something. So 40 million ounces came off of registered, and I believe a lot of that went into the market. So we have another 30, 32, 35 million ounces was imported than was needed. So we're talking about a 70 million ounce increase when you net out COMEX registered gold, silver sales, as well as imports. and the overall market didn't need all that. So what I'm thinking is there are big pockets, big institutions. Some say it's J.P. Morgan, could be, but I think there's a lot more silver buying by these large, wealthier institutions that's off the radar. And I can't give any specifics because we don't know. But there is a lot more buying going on behind the scenes, and I don't think some people think it's the military. I don't think so. I think it's institutions that are quietly buying more silver besides the retail and wholesale demand.
And we do see anecdotal things that speak to unusual background conditions in the marketplace. That whole shenanigans with the LBMA and the silver fix a couple of weeks back, it can easily be interpreted as basically institutional players trying to scramble, dealing with this sudden rush and demand for silver. And whatever was going on there is not 100% clear, but dropping the discrepancy between what was trading in the front month versus the fix that they set and the spot. I mean, you could drive a truck through that discrepancy. It was just pretty shocking.
Yeah, I know KGM Poleska, which is they're the largest silver producer in the world. They produced a little more than 40 million ounces last year. They produce silver as a byproduct of copper in Poland production, and so one of their spokesmen was really wrote about this, and was very perturbed about this, and wanted to understand why could this happen, because I would imagine a lot of their silver was sold at a lower price that day. So I think with this new ADX fully allocated gold and silver exchange, I think you're going to start seeing more gold and silver coming from the miners going there. And so it's going to take away food or, let's say, supplies from the COMEX and the LBMA. I just think it's an ongoing stress, as well as the huge debt. You see, the biggest problem is all comes back to, as I said before, the energy issue and now the debt issue. And they're both related. All the debt in the world, all the U.S. Treasury debt, all the government debt, all the private debt, you have to just think of that as energy debt. Wage earners, their wages did not keep up with the inflation that was driven by energy costs. So instead of it being sold to the wage earners and they couldn't afford it, it was put in debt. And so all this debt has been pushed off into the future. And so now you have all this debt out there, and what you need to pay off this debt is a growing energy supply, which we've had for the last 100 years. Well, we no longer have that. And we have expensive growing energy supplies, but the problem is now, and we're starting to see the gutting of the U.S. shale industry, as well as some of the majors, with this low oil price. And I don't think many readers and your listeners realize, Doc and Eric, that Cushing, Oklahoma, right now, their supplies or their stocks are 85%. They have never been that high before. Most of it runs about 50%. Now it's at 85. The major build for America for their oil stocks, or let's say the petroleum stocks, occurs between January and April. And then we have April, the end of March and beginning of April, we start seeing refiners doing their maintenance, as well as they change over to a summer blend. So we're going to start seeing a pullback of actual refining during those times. So we may get to a point in the United States where we have reached the top. We can no longer add more oil or more petroleum stocks. So even though the price of oil has been going up lately, I think we're going to see another price decline, unless we have a war in the Middle East where it looks like we could. But I think we're going to see the prices head below 20 again, and this is really destroying the U.S. energy industry.
And it, in turn, is creating a deflationary wave throughout the entire global financial system, and in particular the shadow banking system. I mean, this stuff impacts the underlying collateral in the financial system, and that's what we're seeing. And even going back to August of last year, we had that really unusual giant spike in about a 2-week period where the Federal Reserve is putting out, fires in the European banking system by injecting Treasury collateral through repos and reverse repos. There's definitely a fire burning in the background. When you look at the global macro and how the Federal Reserve in particular has been responding with the whole charade of trying to do the interest rate normalization cycle. If you look at the 10-year yield for the U.S. Treasury in November and December, it was cruising along at about 2.25% yield with 15 basis points plus or minus for that entire 2-month period. And then as soon as we hit 2016, and people were realizing that the Fed was just basically blowing hot air and doing a song and dance. I mean, our community always was cognizant of that, but more and more people in the conventional financial world are recognizing that the Fed is stuck. And we peaked out in December at 2.32%, and crashed all the way down to 1.63% yield on the 10-year note just a few days ago, the last couple weeks ago. And now all of a sudden things have flipped around, and we're seeing a lot more money. Or rather, the yield is now bounced back up to 1.81%. And I think that actually is, in part, not in total, but in part, a recognition of the conventional finance world realizing that the Federal Reserve has been blowing smoke, that this whole dot plot song and dance of 4 interest rate rises in 2016 and on, all of it is now largely considered nonsense. And we have this deflationary wave going on that is basically going to force some kind of policy response. And part of what we're seeing now with gold and silver responding is also confirmed to some extent by even in the credit market, because you can look at the treasuries and see that people are demanding more yield.
Yeah, you see this deflation, and it's basically from the lower energy prices. This deflation is a disaster for governments and organizations and companies with a lot of debt. Look at Saudi Arabia. They have to sell treasuries to make up the revenue they're not getting from oil. Now, I have heard that some of these exporters have been selling stocks and getting revenue from that, but on an ongoing basis, if the price of oil remains low, and I think it's going to remain low for a while, these countries, these oil exporting countries, are going to have to continue to sell treasuries to make up the shortfall of their revenue. And again, it's totally gutting the entire system. And let me just add this thing. There's so many bad things about the U.S. shale oil and gas industry. It's beyond a disaster. Now, one more nail in the coffin is everybody has been hearing about increased earthquake activity, and they associate that with fracking, and it's not the fracking. It's after you produce oil, you have a lot of wastewater. There's oil mixed in it, there's actually contaminants, and you have to get rid of that. It used to be injected in shallow wells, but recently, over the last 10, 15 years, 20 years now, they've been injecting it into the deep area of like 5,000 feet because it's cheaper, you can inject a lot more. And now what's interesting in Oklahoma, annual earthquakes were anywhere between 100 and 150 a year, up from 1977 to 2009. That was the average. Last year it jumped to 5,800. And I think last week they had a record 5.1 magnitude earthquake. Now that's not going to destroy a city. But what it does is put cracks in infrastructure, it breaks pipes, it separates home foundations, so there's a lot of damage. That a house hasn't fallen apart, but it needs to be repaired. And now the Sierra Club has just sued, not only did they sue Chesapeake, they sued Devon and as well as Dominion. And it's a lawsuit that just started last week. we're going to see more lawsuits against oil companies for their increase of earthquake damage due to water injection, especially deep water injection. And there's a lot of hearings going on and scientific studies showing what is actually happening. And here's the most horrifying thing. The worst earthquakes can happen 10 years after deep water injection. There's so much water being pumped down in there above the crust that it creates the plates move now. And so we haven't even seen the worst earthquakes yet. So I think what's going to happen, if you're a shale oil company and you're not making any money, you're losing money, you have a lot of debt, why would you stay in business if lawsuits are starting to come down the pipeline? It's not worth it. So we're going to start seeing, I think, more and more companies shutting down due to this threat of increased litigation. So I'll tell you, U.S. oil production is going to start to really decline. And I think that's going to be the final nail for the U.S. dollar coffin.
Well, definitely interesting dynamics. I mean, the potentiation of all these interactions of markets and the deflationary wave that we're seeing now definitely is going to shift everything in 2016. And yeah, it looks as almost a foregone conclusion that we're going to see continued pain in the standard equity markets, and that alone is going to put a pretty strong bid in precious metals. And that's what we've been seeing. You know, the last couple of weeks have been very fascinating to watch. It's not only just the upward moves that we see that have been unusual, and we've spoken about that on the last show. We talked about a couple of weeks back. We had close on a high on a Friday, and the big action we had last week, and this week is now very impressive as well too. But the more significant, subtle market signal intelligence value that I see is actually what's happening in between those spikes. We're moving more sideways as opposed to the cartel or just generic profit taking coming in and pushing prices down. This is what real bull markets look like, and it's amazing to see that for the last couple of months, precious metals, and basically since the start of 2016, with the exception of the first couple of weeks when it looked like the cartel was going after larger mining shares. I mean, if you look at the Huey index, it's sliced under 100 and then all of a sudden rocketed higher in a very abrupt snapback fashion that just kind of looked like the degree to which the targeting of mining shares was more excessive than what was going on with precious metals at that time, too. I mean, we can only speculate. This is not something that we can prove, but it really does look like this is the third phase of the precious metals bull market beginning to snort.
Yeah, and this would be my final comment. I went and saw the Big Short, the movie The Big Short, heard a lot about it, and I think the most important takeaway of that movie was the original gentleman, I think it's Michael Berry, that purchased the credit default swaps. They thought he was crazy. He went into these banks and he'd buy $300 million and $400 million from this bank and that bank of credit default swaps, which was a bet against the mortgage-backed security industry. Well, they were happy to sell it to him. They thought he was a lunatic. And even the investors who invested in this were quite upset. And what was interesting, as the market started to crash, the mortgage market, the housing market started to crash, the premiums on these credit default swaps didn't go down, or they didn't actually increase in value. They had to pay more money. And what they found out was the banks were manipulating the CDS, the value of the CDS, because they were on the wrong side of it. Until they were able to sell all their mortgage-backed securities and dump them on Lehman Brothers and Bear Stearns and wherever, then they allowed the value of that credit default swap to increase. And I see this exactly the same way in the precious metals industry, in the market. I do see at some point in time the value of the real value of the precious metals will be released. And I'm not saying it's in total control of the bullion banks or the banks, but I think at some point in time it will behave in the exact same way. Right now it's being held down, but at some point in time, like you said, Eric, they maybe controlling the price movement up now. It's a controlled increase, but at some point in time, I think they're going to lose control of that.
Yeah, here's a funny thought for you. Many of the speculator within these grand bullion bank, J.P. Morgans, et cetera, I mean, they'll be looking around and seeing the markets move, and they're just going to want to chase it. And meanwhile, from the governmental sector, the official sector of the United States Treasury, Exchange Stabilization Fund, et cetera, all of that MAOU having the interest of making sure that they're protecting the dollar, they may not be able to have such a cozy relationship with the bullion banks as they've had historically, simply because of rats jumping ship and the phenomenon of people following their own self-interest. So it's definitely a confluence of forces here that'll definitely make 2016 a shift from what we've been enduring in the last 4+ years of the stage of bear that we've suffered through.
Everybody's happy to help Bernanke and Geithners and Summers when gold and silver are plunging, but when they're gapping up $50 a day in gold and 50 cents to a dollar in silver, I think you're right, Eric. There's not going to be a lot of bankers who
worry about their own stack.
Yeah, they're not going to want to stay on that side of the ship. All right. So for listeners who aren't familiar with your work, Steve, if you can let them know where they can find all of your excellent analysis.
Okay, if you go to the srsrockreport.com, I put out about 2 or 3 articles a week on the precious metals, mining, and energy markets, and there's a lot of archived information there. And again, as I said, I believe the energy is the key. The energy is what's destroying, or the lack of thereof, of energy. Even though we're having a glut right now, which is so funny, we have a glut of oil, and demand continues to fall. But unfortunately, that this glut that we're having of oil production, it's oil that the world really can't afford. So we're seeing this whole disintegration of the highly leveraged fiat monetary system actually due to energy. And so it's going to be interesting to see how this plays out, and I'll continue to write articles about that, and then let's keep in touch and see what happens throughout the middle of the year.
All right, so we'll wrap this week's show there. So for the Doc, Eric Dubin, and Steve St. Angelo, thanks for tuning into this week's SD Weekly Metals and Markets.